Okay, so Bismillah ar Rahim. Thank you for joining us on this webinar as to why having a Halal RRSP is important. My name is Siddiq Mohamed. I am the advisor team manager for Canada. So inshallah, we'll begin now. First, a disclaimer with regards to this evening's webinar. This will not be for any specific investment advice or anything like that. We are simply just giving some general information. And with regards to the suitability for any of the information shared for you, of course, it's always recommended that you perhaps book a consult with one of our advisors or portfolio manager, inshallah, in order to assess the suitability of any of the recommendations made. So when we're looking at retirement and income planning for retirement, there's many things that have to be considered and really delved upon, which is what we're going to be looking at this evening. But really what we're looking to do is creating a sustainable income stream during retirement years using various investment vehicles. We're also going to be looking at withdrawal strategies and there's some of their tax implications and some other factors to consider as we plan for retirement. So first, I'll begin by giving a general overview on ShariaPortfolio itself. It was started in 2003 by Noshad Virji as Virji Investments. And in 2014, he started providing halal wealth management back in 2003. In 2014, ShariaPortfolio registered with the Securities and Exchange Commission in the United States. It raised some seed capital and expanded operations to 26 states in the US and has been operating there ever since. In 2017, ShariaPortfolio began working in Canada to bring Sharia-compliant wealth management to Canadians. 2 years later, in 2019, SP Funds was launched, which is a separate company. And this is a fund management company. In December of 2019, SP Funds launched SPUS, which is ShariaPortfolio's flagship ETF, as well as SPSK, which is a global sukuk, global sukuk ETF. The following month, in January 2020, ShariaPortfolio Canada officially launched with its registration with the Ontario Securities Commission. It was awarded the Best New ETF Award in that same month. In October, 10 months later, it rang the opening bell at the New York Stock Exchange. And in December, 2 months after that, it launched the Real Estate Investment Trust, SPRE. So that all happened in 2020. Subsequent to that, in 2023, SP Funds launched in December 2023, launched 2 more ETFs, namely SPTE, which is a technology-focused ETF, and SPWO, which is focused on emerging markets and non-North American stocks. This brings the family of ETFs within SP to 5, which is the largest family of halal ETFs in North America, which is a feat that we're quite pleased with and quite proud of. And later on in the presentation, we'll look at how these ETFs are used in order to build a balanced portfolio for our clients. So first, when we look at some of the reasons why in Islam, some of the reasons why it's advisable to be mindful of how we're planning for our retirement age and how we're using our wealth and how we're being responsible with this amanat. We look at 2 narrations of the Prophet, peace be upon him. One where it says, pardon me, no, forgive me, I've got something in my throat. You'd better leave your inheritance wealthy rather than leaving them poor, begging others. You will get a reward for whatever you spend for Allah's sake, even for that which you put in your wife's mouth. This is narrated in Bukhari. And another narration to the effect of, O Messenger of Allah, shall I tie it and rely upon Allah, or leave it loose and rely upon Allah. And this was a question by Anas ibn Malik radiallahu anh, and the Messenger sallallahu alaihi wasallam replied that you should tie it and rely upon Allah. So we're encouraged to take precautions. We're encouraged to be mindful of how our wealth is being used and we should just be responsible with it. From a worldly perspective, I mean, there are many reasons why retirement planning is a very good idea, and why, in particular, halal retirement planning is a very good idea. Simply put, we can't work forever. There comes a point in all of our lives where, we need to be able to stop working so that we can enjoy the time with our family and our loved ones without having to work for our money. We've also seen that life expectancy is increasing as time goes on. People are living for longer, and as a result, their financial needs are longer than in previous generations. However, we're also seeing, with longer life expectancies, we're also seeing more complications, medical emergencies, diseases, illnesses, and these can have financial bearings on our lives as well. So these are something that, it's important to try and plan for, account for when we're looking at our retirement needs, factor in additional medical expenses, perhaps. It's also a really good time to fulfill life's aspirations, right? So for much of our lives, we're busy with either raising children or working and providing for our families or supporting, households or whatever the case might be. And we kind of put off a lot of the things that we'd like to do, right? Namely, being able to travel or being able to take trips with our spouses or our families or whatever the case might be, because we're busy working and looking after everything else. So this is a really good time during retirement age when we're not encumbered by life's responsibilities and working and the job and all of that. Maybe at that time when we're retired, any children may have left the home and they perhaps have homes of their own at that point. It's a really good time to take advantage of fulfilling, checking off some of the things that might be on our bucket lists that we didn't do in previous years. It's also, really important to not have one source of income at that time, namely our pension or whatever it is that we contributed towards. Here at ShariaPortfolio, we tend to recommend having 3 different asset classes when a person retires, namely, real estate, equities, and commodities. But it's something that we want to be able to start contributing to at a younger age and building it over time, so that when retirement age does come around, we have a diversified retirement stream, right? That's coming in. We also don't want to become dependent on our children when we stop working. We don't want to be a financial burden on others. We still want to be able to enjoy financial independence. So it's really important to start planning for this so that our needs are met by our retirement income, by the funds that we've already put aside for our future selves. And of course, we want to continue to contribute to the family. We want to be able to contribute to support our children, to support perhaps our grandchildren at that time. These are all reasons where, we have to have money put aside so that we can do all of these things and still have a very comfortable life for ourselves. So it is very important to start planning early and to, again, have a diversified set of investments that we're kind of earmarked for this purpose. One of the sayings of Warren Buffett, a very prolific investor of our time, is that he believes that there's no stronger force in the universe than compounding. If a person starts putting aside just a little bit of money every month at a young age, but continues with that same little bit throughout their lives, it grows exponentially over the course of many years, versus a person who starts saving later in life and putting aside money later in life. That money does not have the opportunity to experience the same exponential growth as the one that started at a younger age. So it's really important just to start young, even if it's not with a large amount. Just start young and put aside money monthly, inshallah. So when we look at the different tools that are available for retirement, there's multiple account types that we have available to us here in Canada. Many of them are registered accounts, meaning that they're registered with Canada Revenue Agency. We have self-directed plans, we have spousal plans, group plans, locked-in retirement accounts, which are all, kind of pre-retirement. And then after you enter into retirement, these locked-in plans or these self-directed or spousal, they get converted into either a RIF, which is a registered income fund, or a LIF, a life income fund, and a locked-in retirement income fund, LRIF, which these are account types which are post-retirement. Post-retirement meaning minimum of 55 years of age, where an individual can then, draw down or draw from these funds that were invested. Now, what's important to understand is that contributions made towards any of these accounts, so like a registered retirement savings plan, an RRSP, or a locked-in retirement account, or any of these contributions, they're tax deferred accounts, meaning that any growth that takes place within the account is not taxable at that time until the withdrawals start coming out, right? When the person starts withdrawing from the account in their retirement age, that they will be taxed as income, right? But any growth that takes place, so a person starts investing in their 20s or their 30s, and the account grows due to capital gains or dividends or what have you, any growth that takes place is not taxable at that time. It's tax deferred. So only when the person starts to withdraw. This is an important consideration because you're shielded for a certain period of time until you start withdrawing. The idea there is when you do start withdrawing and you do have to pay income tax on those withdrawals, the advantage is that you would, hopefully be at a much lower tax bracket in your retirement age than you were during your earning age or your accumulation age of your working years. We also have pension plans and defined benefit plans. These are, a lot of companies offer these where the employer will match a certain amount of your contribution towards a registered plan. And what this does is it ensures, an income stream during retirement. You have your employer defined contribution plan or defined benefit plan. And this is something that's often managed by a plan administrator selected by your employer. In Canada here, we have many such plan administrators. One of the challenges from a halal perspective or from an Islamic perspective is that there's not a lot of control regarding how the funds are invested because it's done by the plan administrator. So it's something that you have to consider. But if you are with that employer, that is what you're with. What I can say though is that if you are with Manulife, for example, you can request SPUS, which is our flagship ETF, as Manulife has started offering that through their pensions. When you do retire and you have an employer-based plan, you do have options. You can take that as a lump sum, or you can take that as income over time. Other examples of these defined benefit plans are like CPP, which we all contribute towards, old age security. Again, we all contribute towards these things, and guaranteed income supplement. These are all defined benefit plans, but only they're offered more at a government level as opposed to a corporate level. Another tool that people are using, which is a great use of this account type, is to use your TFSA. So a tax-free savings account is different than an RRSP account, for example, in the sense that when a person contributes to an RRSP account, they will receive a receipt for their contribution, which they can use against their taxes. That's not the case within a TFSA account. You don't receive a receipt. However, the advantage with a TFSA account, which an RRSP account does not have, is that the funds can be withdrawn at any time with zero tax consequences. So, and this includes any gains that took place within the account. So if a person invests a certain amount, say they invest $1,000 and they make a 20% return, for example, and their account goes up to $1,200, they can then withdraw that entire $1,200 at any time without paying any capital gains on the 20%. There's no tax deferral, it's tax exempt. So a lot of people are turning towards TFSAs as a means of meeting their short-term investment needs or liquidity needs, but it can also be used towards retirement, because you can park money in your TFSA. It can grow on a tax exempt basis as opposed to tax deferred, and then can be used during retirement. One exception, which is notable to this, is that there are withholding taxes on dividends from US-based stocks. So if you have a US-based stock in your TFSA, and that is paying a dividend, so you have income coming in from that US-based stock, then there will be a 15% withholding tax on that dividend that you receive from that US-based stock. That's an important exception to the non-taxable feature of a TFSA. But again, all other withdrawals are not taxed at all. So any money that you withdraw, it's not taxable. You can also use a non-registered account or a cash account as a means of investing towards retirement. And some people will do this if they've reached the contribution limit for their registered accounts. So for example, if an individual is contributing towards an RRSP, there's a contribution limit that can be reached. And to find your limit, to know your contribution limit, the best way of doing it, honestly, is just look at your most recent notice of assessment, which you can access through your portal on Canada Revenue Agency's website. And right near the beginning of your notice assessment, you'll see your limits, your contribution limits for your RRSP, as well as your TFSA and any other registered accounts that you may be interested in. So if a person has reached their contribution limit for their RRSP, they can then put additional money into a non-registered, also known as a cash account. And any growth or income or gains are fully taxable because this is a cash account, it's non-registered. So any dividend income or capital gains, this would be taxable and have to be, treated as such when filing your taxes. And finally, another tool that individuals can use for their retirement as they reach that age is downsizing their home. And we are seeing more and more people doing this as they experience, kind of the empty nest phenomenon, where, the children have left the home. Maybe they've moved on to homes of their own with starting their own families. And, there's a lot of extra space now. The house is empty. And it can make a lot of sense for a lot of couples or a lot of individuals to downsize their home into something that's smaller, more manageable. And that frees up a lot of equity in the form of cash that they can now use for their retirement. So this is another tool that individuals can do. And it can have a lot of benefits as well, because it both from a financial perspective as well as just, making it an easier, smaller space to manage in our retirement years, less floors to clean, so to speak. Now, obviously, when we're considering our investment management and our risk, our retirement funds, there's a lot of risks that we have to consider. And we've listed some of the risks here. And these are all things that a portfolio management team has to consider when managing individuals' retirement funds, because there's geopolitical risk, there's reinvestment risk, capital risk, foreign exchange risk, sovereign risk, market risk, industry risk. There's a lot of things to consider. And this is where, a skilled portfolio manager is very, very important to work with, so that a lot of these risks are hedged against and mitigated against, so that, funds are managed properly to account for these different types of risk. And one of the most often forgotten types of risk is longevity risk, meaning that we want our funds to be able to outsurvive us. We want our wealth to be able to survive our own lives. So longevity risk is the economic consequence of outliving financial resources, our own money. So there's often this tug of war that takes place between wanting to, preserve the capital and have the money, kind of stretched as long as possible, as being tugged against meeting our day-to-day or month-to-month living expenses, consumption. So this is where it's really important to sit down with an advisor, to sit down with a portfolio manager, and have a conversation regarding what those financial needs might look like, so that it can be planned out properly, and that longevity risk can be accounted for, so that you're not in a situation where you're out surviving your retirement assets, and then you're not left with anything. It's really important to consider this, so that again the wealth kind of gets stretched and gets used over the appropriate amount of years that we foresee living. And as we're considering that calculation, it's really important to factor in inflation. One measure of inflation is the ergonomics. It's kind of the benchmark, if you will, for inflation. Back in 1986, the cost of a Big Mac was $1.39. Today in 2024, it's $6.19. Right. So this is, and again, it's across the board. We use Big Macs here. I'm sure that in a few years, where I live here in Montreal, or many of our clients in Toronto can probably use a shawarma index or something similar. But I mean, the reality is that over a 38-year period, this particular commodity has gone up, or product has gone up by just over 400%. Right. So I mean, it's something to factor in when we're considering that stretching of our money, and that meeting our future financial needs. We have to take into consideration that prices are rising and will continue to rise, and the dollar that's being stretched so far today is not going to be stretched as far as 20 years from now, for example. So this is a really important consideration. When we look at the average annual increase, it's about 3.7%. However, we can have years where that spikes significantly more. If we look at this chart, for example, this is an indicator of inflation over the past, say, 30 years. We can see that there are periods of less volatility, but then there's periods of much greater volatility. More recently, for example, if you look at the 2020 section of the graph, it goes from just about 0 to 7.5%, which I'm sure everyone here probably remembers what happened during COVID with rising prices right across the board. But these are things that can happen in our economy, and they're things that we need to be able to forecast for, as well as prepare for, really. I mean to say, so that if we do experience things like this in our retirement age, we have a bit of a buffer to be able to weather a situation like this, so that it's not causing any undue duress or stress on our living situation, because at that time, again, we are on a fixed income basis in our retirement age. So again, considering the inflation and the various pressures that affect pricing is a really important consideration when we're planning for retirement. So when we're looking at how to manage a portfolio, or how to consider the investment planning process, there's multiple steps that we take. The first is to understand the time horizon. So for example, if there's a potential client, or a client of ours that is considering retirement funds, or ShariaPortfolio to manage their retirement funds, first we want to understand the time horizon before the person actually wants to retire. Is that 5 years, 10 years, 20, 30 years? What is that time horizon, so that the wealth can be managed appropriately? The next step is to determine retirement spending needs. And this is done closer to retirement age. So, typically the younger an individual is, the more time that there is the more aggressive a portfolio manager might be in managing their portfolio. And, kind of the older a person gets, or the closer to retirement, or even leading up to pre-retirement, is the more conservative that a portfolio manager might become in managing that individual's wealth. But in a pre-retirement situation, or entering into retirement, that's where we want to determine the retirement spending needs. So what is, what's your lifestyle? What's your expenses? What are the costs that you're incurring? So that, are there other sources of income that need to be considered, such as a pension, or maybe there's, rental income coming in from a property, or just get a total picture of all the sources of retirement income, and look at what those spending needs are on a monthly, quarterly, or annual basis in order to devise and calculate after-tax rate of investment returns to meet those needs on an ongoing basis. So this is an exercise that's done, again, just pre-retirement or just entering into retirement, so that the portfolio management team here at ShariaPortfolio can understand your needs and understand what the financial realities are in order to meet them. And this is why it's really important to have a very good financial advisor, someone that you can sit down with, speak with, and who can understand and take the time to understand your unique situation. And again, relay this to the portfolio management team, who can then make the appropriate recommendations. In this infograph, this really shows some of our passive portfolios, or it shows all of our passive portfolios. They range from sukuk, which is a very conservative sukuk. For those who are perhaps unfamiliar, it is halal fixed income. We launched SPSK, which is down the bottom right corner, this mustard color slice of the pie, so to speak. And this is halal fixed income. So it is, it's an ETF that pays a fairly reasonable dividend, but it's income focused. It's asset backed and income focused. The other sort of lower risk, relatively speaking, to our equity based ETFs is SPRE, which is a real estate investment trust. So this real estate investment trust is, again, it's focused purely on real estate companies that pay a reasonable dividend. And this is, again, very, relatively speaking, lower risk, lower return, but it's very stable and provides income. So the more conservative an investor is, the more exposure they have towards SPSK and SPRE, right? Conversely, to the blue pieces of the pie here, so to speak, which are all equity-based. Right? These are namely SPUS, which is our S&P 500 Sharia-compliant exclusionary index, or ETF, rather, SPTE, which is our technology-focused ETF, and SPWO, which is focused on emerging markets or non-North American equities. So again, the more aggressive an individual is in their portfolio, is the more exposure they have towards the equity-based ETFs and less exposure towards the SPSK and SPRE. So again, when we're sitting down with a client or a prospect, it's really important for us to understand what your unique situation is, and we actually have a fairly comprehensive KYC that we ask, which know your client document that we ask everyone to complete, so we can get a very, very good understanding of your unique situation, your needs, your time horizon, your experience in the market, your risk profile, and then our portfolio management team can make an appropriate recommendation as to where on this spectrum you might be a good fit. So this is how we work with our clients in terms of trying to plan for that eventual retirement. And this can, of course, change over time. An individual who comes and starts saving towards retirement in their late 20s or early 30s, they might be an aggressive client at that time. And as they move closer into their 50s, or perhaps 60 or so, they can be moved over time down to conservative. So this can be adjusted over time, but it's something that is really important to discuss suitability with the portfolio management team, in conjunction with the advisors, to find out which model is best for you. And so we have a tremendous amount we've had a tremendous amount of success, alhamdulillah, both in the US as well as now here in Canada, because we are fully independent and we offer only halal wealth management. That's all that we do. We follow the AOFI guidelines for Sharia compliance, which is the global standard in Sharia compliance. We operate as a fiduciary, so we're not uh, we're not motivated here by commissions or fees or things like this. Rather, we are obligated to operate in the best interest of the client. That is, that's part of our mandate. That's part of how we operate. So it's very important to distinguish, because there are other firms that don't operate as a fiduciary, but we do, and it's something that we're quite proud of, because it means that we have to put our clients first, and something that we feel a very strong amanat or trust to do. Our focus is to align our values as Muslims with our clients' financial objectives. So this means investing according to our values, putting our money into things that are compliant with our deen, that are that are in line with our values, and avoiding things which ultimately, as Muslims, we don't want to participate in. And it's something that we're very proud to be able to offer now in Canada, and it's something that we found is doing quite well, alhamdulillah. We also offer discretionary actively managed portfolios. So in the previous slide, I showed an infograph for passive accounts where we just have the ETFs, but we also have actively managed accounts where we use what's called a core satellite approach to investing. The core of the funds are still in those 5 ETFs, but the satellites are in individual stocks that are selected for our clients by our portfolio management team. And this is where typically we see a lot more alpha or a lot more returns in actively managed accounts because of the presence of these individual stocks. We have a very experienced team here, alhamdulillah. Our portfolio management team, our compliance team, and our advisory team, as well as our customer service team, are all highly experienced professionals that are working very diligently to service the needs of our clients right across the country. And we're very, very proud of our team, alhamdulillah, because they work very hard. And we also have a custodian relationship with Fidelity Clearing Canada, so that when an individual is becoming a client, they're opening an account with Fidelity, and their funds are in their name, and the funds are held by Fidelity, with ShariaPortfolio Canada being the designated portfolio manager on the account. So Fidelity is not involved in any of the decision making where what equities or what ETFs or what stocks are being held. They're simply the custodian. ShariaPortfolio Canada are the portfolio managers on the account. So with that, that concludes our presentation. Jazakumullah khair for all those who participated. We will open it up now for any questions that anyone may have. I can see that we have one here. And the question is, does Sun Life have anybody for your funds? So presently, Manulife does, but Sun Life has not yet started to offer any SP ETFs. So that would be a no for now. But inshallah, if that does change in the future, we will absolutely let you know, inshallah. Any other questions? I'll give folks a few minutes to type it in. Yes, so we have a question coming in. Assalamu alaikum. How does your fees compare to a generic account in a bank? Excellent question. They're actually very much in line with the same fees you would pay at a bank. The fees for being a passively managed client, and again, a passive client is the one where you're just getting the 5 ETFs, which is great because they're performing well, but there's no individual stocks. And the fee for being a passive client is 0.5% of the assets under management, billed annually, and calculated annually and billed monthly. So that's to be a passive client, 0.5% of the assets under management. For an actively managed account, the fee is 1.5%. per annum. And that's, again, billed monthly, which is, again, very much in line with what the banks charge. These are the fees charged by ShariaPortfolio Canada for managing the assets. Our custodian Fidelity does have their fees as well, which is a $10 transaction fee. So that goes to Fidelity. But these fees are very much in line with industry norms. Thank you for the question. We have another question coming in. Please provide more information about sukuk, SPSK. So sukuk, I'll give a little bit of insight. So sukuk are halal fixed income. So the word sukuk is the plural of saq. Saq in Arabic means to strike or to hit, as though to make a sacred pledge on a document. Saq is actually the root word or the origin word for check. The word check comes from saq. The instrument check comes from saq. Right? This is something that is an Islamic invention, where you can, when you're signing a check, you're striking your name, or you're making a sacred pledge to meet a financial obligation at a specific time. So what a sukuk is an issuer of sukuk will give out these securities, and in lieu, they will give up ownership of their assets to the amount equal to the amount of the investment. And this is typically done for a fixed period of time, at which point the investment is bought out. And during the period of time when the sukuk issuer has taken in that money and has pledged ownership of assets to the investor is then entitled to a percentage of the profitability of the economic activities of those assets. So this is where the income comes from. But the important distinction, so it operates very similarly to a bond in many ways. The notable difference is that there's no debt, there's no interest. It's an equity ownership that's taking place in the asset, with a return being derived from the profits of the sukuk activity. So this is what, so SPSK, and most of the issuers, if you look at the SPSK holdings, many of them are sovereign sukuk issued by the Kingdom of Saudi Arabia. Some of them are from Malaysia, Dubai as well. So these are typically some of the entities, and there are corporations in there as well that have also, like Saudi Aramco is in there. A few others, I think Malaysia International Bank is in there as well, if I'm not mistaken. But these are some of the issuers that issue sukuk. And so we took these companies or these entities and we formed SPSK with them. So that's the underlying, so these are the underlying assets. When a person's buying SPK, this is ultimately what they're buying, is these sukuk issuers. So again, it's from a volatility perspective, it's relatively low, especially compared to the equity-based ETFs. But it does pay a handsome dividend. Another question coming in: who else other than Manulife offers SP funds? In Canada, Scotia Investment now offers SPUS, though I think they call it something else. But they do, it is SPUS that they offer. That's someone else who offers it, and I believe there's another bank, but I'd have to confirm it. The name is, if it's RBC or BMO, but I'd have to confirm that. So I'm happy to get back to anyone else who asks any other institutions that offers SP funds. Another question coming in: when are the fees charged? Also, I suppose it is charged from the return. So the fees are charged monthly, mostly at the end of the month, if I'm not mistaken. And the fees are not charged on the returns, they're charged on the assets under management. So, for example, if a person has, a passive account with $1,000 in there, then their fee will be 0.5% of $1,000. And that's the annual fee on the account. And that fee is charged monthly. Okay, so that's just by way of a numerical example. It's not on the returns that are generated, but rather it is on the total assets under management. And that's again calculated on a yearly basis, and then it's charged monthly. Every month is when the fees are charged. And we have another question coming in. Please, can you talk about investment for children, RESPs? Sure. So we do support registered educational savings plans for children. And this is an excellent way to plan for paying for your children's education. And we manage it in the same way with the same ETFs, the same strategies that we can manage for a retirement plan, only we can do it for an RESP. The advantages of investing in an RESP is, first, you receive a grant from the government equal to 20% from the federal government, which is equal to 20% of your contribution to a maximum of $500. So, for example, if a person were to contribute for one child $2,500 in a year, the year ending December 31st, of course, that 2,500 would be matched up to 20%. So you'd actually receive $500 from the government, bringing your account up to 3,000. That's from the federal, and certain provinces also have their own top up or grant amounts as well. The other advantage for an RESP account, so that's great. You're right off the bat, you're getting effectively free money from the government for planning for your child's retirement. And that's separate from the growth that you experience in the account from the funds being managed. The other advantage is that any growth that takes place within the account is tax deferred. So, if you start when the child is very young, and you invest right up until, for example, they're 18 or so, which is the age when children typically start to withdraw because there's college or university or what have you. Then that money, that withdrawal, is treated as income for the child, but most children that age are not making much income, so there may be minimal or negligible tax consequences for the child. The provision there is that the child, in order to withdraw in that manner, they have to be enrolled in a qualifying accredited institution, and they have to be able to demonstrate proof of full-time enrollment in order to receive that withdrawal. If they do not, and if they want to pull the money out because they're not going to a qualified institution, then the government may claw back their contributions because they're not being used for that purpose. Another question coming in: what is a minimum amount required to start investing? Excellent question. To be a passive client, we've actually made it very, very accessible. The minimum to become a client as a passive investor is $1,000. So it's very attainable. It's very achievable. The minimum to become an actively managed client or have an active account, it starts around 100,000 because it does take more capital in order to diversify into the ETFs as well as buy individual stocks. But to be a passive client, it's very, very achievable. $1,000 is all you need to become a client. And we have RDSP. So at the moment, we do not. Fidelity does not support a registered disability savings plan. This is not something that's presently supported. If that does change, it is something that we can put out in a newsletter. But at this present moment in time, Fidelity does not support registered disability savings plans. But very good question. Thank you. Some really good questions coming in. Okay. Any other questions? We have one more. A question coming in: I have an RSP with RBC. How can I transfer it to a Halal portfolio? It's really simple. Well, if you email me here, I'd be happy to walk you through it, but the steps are really, really straightforward. You would simply fill out our Get Started form, which is on our website. I can email you the links. We ask all of our new clients to complete a KYC form. I'm happy to send you that link as well. And from there, we prepare the documents which would open your account at Fidelity. We send those to you via DocuSign. We open up your account. We also have you sign, if that's something that you want to transfer over, we prepare all the documentation for you to sign a transfer form. And then once your account is opened at Fidelity, your RSP account, the funds are then transferred from RBC to Fidelity. And then ShariaPortfolio can then start managing that retirement wealth in a halal way within your RSP. And because the funds are staying within your RSP the entire time, it's going from one institution, namely RBC, to Fidelity, there's no tax implications for you. It's a transfer. So there's no taxable implications whatsoever. You're just getting the same portfolio, the same fund, but sorry, the same account type rather, but managed in a halal way. It's very, very simple. But anyone who needs help with any of this, I'm more than happy to help you. My information is there on the screen. Please send me an email or shoot me a text or what have you, and I'm happy to assist, inshallah. It's very simple, and we pretty much do all the legwork for you. Excellent question. Do we have any other questions? I'll give a few moments here for anyone else who may want to type something out. Okay, so inshallah with that, if there are no additional questions, I think that we can then conclude. I want to thank everyone for attending and for being engaged. I really love the questions and I really appreciate them because they're all very, very good questions. And that's a big part of what I really enjoy is being able to engage. Oh, there's one other question. A person is asking me about a specific fund at RBC and if it's halal. I would encourage you to please contact me directly on this question. I'm happy to look into the fund and we can run some of it through to see if it is halal or not. But it's something that I would need to look into in order to answer that question. So if you do want to contact me, please feel free. My contact information is right on the screen so that I can look into this fund and any other that you might be curious about to know if it is halal or not. But very good question again. Thank you. Okay, so I want to say Jazakumullah khair to everyone who attended. If there's any way that we can be of service to you, please feel free to reach out. And with that, inshallah, we will conclude. So, assalamu alaikum.